evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly video for the 21st of May, 2020. It was a range day that centered on the upper edge of the expected move, beneath that upper expected move, and closing right just beneath it. So let me take a look at that with you and describe what we're looking at, how this plays in, and how to make the trades for Friday, and I think ultimately into next week. So here's Don's weekly expected move chart. This is available, of course, in the shared studies grid here in TheoTrade. We reference this both as intraday traders or as swing traders or just option traders with respect to these levels. So this week spent the entire, or price at least, spent this entire week skirting the edge of the expected move. It does give us intraday edges, which is just a trade setups and trade logic on the departure away from. That was Monday into Tuesday, the return to Tuesday into Wednesday, and another return to, under, and back into, and that's Wednesday into Thursday. So we'll look at that just in a minute, but keep in mind, the weekly expected move is probably the dominant thing playing into the markets in this week. If you found this week a little confusing, this hopefully puts that into a better context. So it's 2957. This is our intraday chart. Those of you who do trade with the intraday trade frames here, again, think of it like a magnet. So down toward, and once it broke back beneath it, back above, and all these sort of things. So again, we can talk about this tape in this session and this week, which is happening right here. We'll come back to this in a minute. The week skirted the weekly expected move, which just puts it into perspective. The other thing we're watching, and it's the same identical logic, and all we're saying is that the market is into the weekly expected move. It's essentially burned up all the gas getting here and has a good odds to pull back. Doesn't guarantee it will pull back. We can see on the chart, these kind of blue type of lines are when the market moved and closed, or at least exceeded, when outside, the weekly expected move. So it's not like it's going to essentially hit this and go the other way. It can certainly play within, but as an advantage or as a trader, this type of logic does give you the edge. So that's in play too. The volume profile, which is a chart that I like to use with the intraday frame, that also played majorly into the S&P futures today. In the chat room, I kept saying 2950, and that's just beneath the Don's 2957. It might not be surprising whatsoever that the market stalled into a tight, very, very compressed range for all day. Back to the profile, we're still setting up the sell signal, and that's going to be, again, weekly expected move, skirting the edge of it. The value area extreme, which is yellow, it's up here. The market essentially topped at the moment into the value area extreme, and that's 2977. That is underneath 3000, key reference level, and a round number, and the point of control, which is roughly 2950. Again, this helped you with your intraday trades. Now, let's help you out with your swing trades. You're probably still short. You should be. You're probably still net bearish. You should be. And you probably still have negative delta. You should. Doesn't guarantee success. We're going to look at hedges. We've been discussing this all week in the videos. But if you haven't put a sell or bear type of position, be it maybe a back ratio or a bear put spread, bear in-out spread, might not be too late to do that. But generally, when you're at the edge of the profile, we can pull back to an hourly chart, just to see the progression here, and the same type of logic. The goal is not to get the trade perfect. I'm going to get it right at that exact minute, that exact moment, that exact price. It's when you're above a yellow line, there is an advantageous sell type of strategy. When you are beneath, just like you're beneath the weekly expected move, which would be also a blue line here, just for reference, in terms of the week that we're talking here. We haven't really played into it at all, but 2863 is the close of last Friday. The lower bound of the weekly expected move is roughly 2771. Comes into play essentially the same thing. So just kind of showing you how we look at these charts. We'll duplicate that and put it at 2771. And that will show how these levels play in. Profile as well. What are we saying? Bearish, advantageous short, advantageous bear positions. And that is in the S&P 500, playing at least to the midpoint down here. That's a good advantageous target, maybe all the way to the bottom of the VA extreme, which again is profile logic. Think of it like a standard deviation or a bell curve. When you're here, good chance to go to the other side or the middle. When you're here, good chance to go back up. That same logic will take place within stocks and of course the equity futures, SPY, DIA, quad Qs, and all the other index components. Same logic with SPY. By the way, the levels in it, roughly 29250, and you can see how we've spent time above it, and the advantageous, right, not a guaranteed, but advantageous position is to go short to play for a scalp or a swing to the downside. And again, same thing with individual stocks. When you're beneath it, good to go long. When you're above it, good to go short. These are stocks that are strong in today's session in the S&P 500. Lockheed Martin, Nike, and the same type of logic plays out. Whether you're going to trade with us on the intraday futures, trade on the spreads on the indices or the ETFs, the same would be true with the XLF, XLK, which starts, or maybe, possibly, is starting its own little sell swing, or any other component, including utilities. So the same logic will play into that. Now, for the week ahead, we only have Friday, but next week sets up another trading week. Maybe we'll get a departure. That's what I want to caution and talk about and discuss. And it's the same type of thing we've been discussing earlier with you too. So in terms of the SPX, right, these are the blue lines of the expected move just put on the chart. We are at a critical point, and that critical point takes us way back to 2018. So let's go back in the perspective. And right now we're just talking, what if something goes wrong? We have to be hedged. We can't be over leveraged. We cannot be overconfident. We have to be a trader, and a trader is one who admits they don't know the future. We just know probabilities. Yes, the probability is to come down away from this 2950, ultimately 3000 if it ever gets to that pivot. That's a great, another advantageous short. But the hedges are necessary. Bull vertical spreads or some type of way to protect yourself in the event that the market does shatter through 3000 and keeps going. And there's precedent for that, but that would certainly be a lower probability outcome. But if it happens and we bury our heads in the sand, we're going to lose significant amounts of money. And that's in spreads. You are fixed to what you might lose. If you are just short shares, that is essentially, it won't be unlimited, but we have to say the word unlimited risk. If you do remain short and the market does go and makes a new high, that's going to be significant down draw to your account. We don't want that. So prepare for the possibility. We call it the alternate thesis or the unexpected move that takes the SPX or other indices above their resistance points. And just happens to be the weekly expected move, the outer VA extreme. Those are all short-term pivots. And they help us on the short-term trades and day trades, of course, intraday trades. But I know most of y'all are like me and like most of us in TheoTrade. We are biased a little bit short, not biased, but trading or portfolio is leaning a little bit short, maybe a lot short. So all I'm saying is in the case the market breaks to the upside, it will be good to have at least some. Don't put full zero delta. That's not really trading. That's delta neutrality, and that's a completely other way to trade. But if the market does break, prepare for that outcome, whatever that means to you and your account. That might be selecting strong stocks getting stronger, and we can look at some of those, which includes Amazon, which just made a new weekly high this week, Netflix, and not to pick on these names, but strong stocks that get stronger, we like to buy them on pullbacks or retracements. Netflix is one of those names. You can always scan for stocks that are making new 52-week highs. We take a look at those as well, and we'll see these will go new yearly highs. We look at the S&P 500. There wasn't a lot making new highs today. All right, we'll go back to the daily chart and see this. But Synopsys made a new high. Facebook, surprisingly, didn't stop going. It burst through its swing high from 2019 and 18, and that's on strong volume. CMG, which is Chipotle, a famous little overpriced burrito, its stock made new highs. And just mentioned Amazon, which made a new high this week. So these are names to be watching on a hedge. The logic is if the market does turn and go to the upside, shattering above 3,000, these stocks will go with it, and just about every other name. So be prepared for that. Obviously, the probability favors down, but that doesn't guarantee that's going to happen. So as a trader, be careful, be cautious, be safe, be hedged. Do not be over leveraged. Always be careful and safe. This is Corey Rosenblum with your Theo Nightly Video for May 21st, 2020.